This is the joint webinar between the Finance Banking Network and the Economic Policy Network within AVSE Global. It's also our age webinar age so far. And I would like to give a kind introduction to our keynote speaker today, Associate Professor 𝐤𝐴 is the Director of Doctoral Study at the University of Sydney Business School. He received his PhD in Finance from the University of Cincinnati. He is also hold an advanced diploma from Moore Theological College and Master of Art in Accounting from Sun Yat-sen University, graduate diploma from Johns Hopkins University, Nanjing University Center for Chinese and American Studies. A Bachelor of Science in Physics from Fudan University, China. Prior to joining the University of Sydney Business School, he was a faculty member at Rotterdam School of Management, Rotterdam, Netherlands. His research interests are in the broad area of corporate finance, accounting, and capital market. His academic articles have been widely published in major international journals in accounting, finance, international business law, and general science. His research has been cited by various media such as The Economist, Munich, Harvard Law School Forum on Corporate Governance, Duke Law School, FinRec Blog, and among others. So that's our speaker today, and Professor 𝐤𝐴, who is as the main theme of our speaker. This is not mentioned in his profiles, but as you can see that Professor 𝐤𝐴 has published in very top tier financial journals as well. That's it. One of the point we are pleased to have our keynote speaker today. And just a little bit about myself. My full name is 𝐻𝐼. I'm currently a doctoral student in sustainable climate finance, where my study focus on the climate risk and international capital market. So that's why I'm very pleased today to host our speaker with our webinar team, Global Initiative in Sustainable Finance, Corporate Sustainability, and Economic Policy, where Associate Professor 𝐤𝐴 will give his speak on his recent research on climate-related disclosure commitment of the lender, credit rationing, and borrower environmental performance. Professor 𝐤𝐴, normally the speaker would have 30 to 40 minutes for the keynote speak, but it's up to you. Could be longer or could be shorter. Then we have an open discussion with Q&A part at the end with the audience, where I and the organizing committee will have the open discussion with you today. So the stage now yours. Would you mind to start your keynote speak now?
Thank you very much, 𝐻𝐼, and thank you very much the organizers for inviting me to give the a research talk here. So I'm really grateful, and this is early stage of our research, and I really welcome suggestions and comments as well. So basically, this topic is about climate-related disclosure commitment of the lenders, credit rationing, and borrower environmental performance. And this paper is basically co-work with my colleagues, Iftikhar Hassan at Fordham University, Hae-Kwan Lee at University of Sydney, and Anthony Saunders from NYU Stern. So yeah, so we all know that climate change now grab attention all over the world, right? So there is growing threats of climate change to human societies. This is now become undeniable if you look at the amount of carbon dioxide that we release to the air every year, and we look at the global warming. We look at the bushfire in Australia a few years ago, and now if you look at the very high temperature in the northern hemisphere in this summer, many people actually die because of the heat, right? And yeah, like for example, the ice cap in for example in the Arctic actually melt down, so sea level is rising. So you see all of these consequences of human activities. So climate change is not really something that we have to pay attention. And yeah, the financial sector recently was cast in the spotlight as the main financier of the fossil fuel sector. Basically many people blame that the financial sector actually contribute to global warming by provide financing to those fossil fuel firms, right? So for example, the aggregate amount of investment made by 60 largest commercial investment banks into the fossil fuel industry was estimated at more than 3.8 trillion US dollars from 2016 to 2020. So this is a significant amount of money being injected into the fossil fuel industry. Basically, many people believe that the financial institutions can do something to help save the planet. So, for example, this Financial Times article in 2020 basically says that the financial sector was seen as the conduct into the market. If you can measure the ESG implication of capital, that then you can actually achieve change across all sectors, right? So basically, this writer from Financial Times believe that the financial sector is really instrumental in doing something to help improve the ESG records of the borrower firms. So if you can track down the ESG implication of the capital that you provide to the borrowers, then you can achieve change across the sectors. And Wall Street Journal in 2021, last year, basically says that the works banks and investors can deliver the financing needed to get the word on the pathway to reduce carbon emissions. They could provide cheap and plentiful financing for green energy producers and make it more costly for fossil fuel producers to raise cash. So basically, idea is that if the financial firms, if the financial sector can do something, for example, increase the financing cost for the fossil fuel producers and reduce the financing costs for the green producers, right? Then you will be able to help actually make some change in the real sector. And there are more and more voices demanding the financial sector to improve its climate-related disclosure, improve transparency, right? How much you actually, how much financing you actually provide to the fossil fuel, to the brown firms, right? So many stakeholders demand transparency from the financial sector, and this lead many governments to demand disclosure in climate-related issue finance from the financial sector. For example, the UK is the first country to adopt a mandatory climate-related disclosure requirement for both financial and non-financial firms, starting from 2025. And the US SEC, the Securities and Exchange Commission, has proposed a rule in 2022, this year, that will require financial institutions to disclose carbon emitted by their financing portfolio. And then the International Sustainability Standards Board, which is an organization under the IFRS Foundation, also proposed standards in 2022 that will require financial institutions to disclose the emissions linked to financial assets. So we're going to see more and more disclosure requirement to the financial sector, ask them to provide transparent information about how much financing they really provide to the fossil fuel industries. So that leads to our research question. Our question is, does lenders' commitment to more transparent climate-related disclosure will be able to help improve borrower firms' environmental performance or not? Many people believe that it will. If you ask more transparent disclosure, it will. But there are also some papers recently published in highly influential journals, such as Nature Sustainability, which basically saying that this may not be the case. Doing this, ask them to provide more transparent information may not really help to improve the green financing, to reduce brown financing, and to improve environmental performance. So it's really, at the moment, there is no clear evidence in this aspect. This is what we hope to do to provide fresh and concrete evidence on whether improving transparency in climate-related disclosure from the financial sector will be able to help improve the environmental record of the real sector. So in our research, we're going to look at, first of all, whether the borrower firms of those banks that improve their commitment to transparent climate disclosure, whether the borrower firms will be able to improve their environmental record. We proxy the environmental record by 3 different measures. One, the first measure is the likelihood of being enforced by EPA, by the U.S. Environmental Enforcement Protection Agency administration. So the impact of the on the borrower's likelihood of being subject to EPA enforcement. And then the second measure we use is the aggregate toxic chemical release from the borrower firms. Would they actually reduce their toxic chemical release to the environment or not? And the third measure we're going to use is the very influential Kld Environmental Score, which Kld is a company that basically rate environmental performance of several thousand firms around the world. Basically, their environmental score is pretty influential. Of course, Kld was recently taken over by another firm, but its environmental score is still widely used by many researchers to measure environmental performance. So, so this is our first research question, and the second question is if we can document any impact on environmental performance of borrower firms, what is the mechanism of those impacts? Is that because the banks tighten their credit supply to borrower firms, or is that because the banks actually actively monitoring the borrower firms to improve the environmental record? We want to understand what is the mechanism behind. And we also want to look at what is the real impact to those borrower firms. Would they, for example, if the banks reduce their credit supply, would the borrower firms more likely to be subject to financial constraint, right? What is the impact or implication to the valuation of those borrower firms? So this is basically the 3 strand of questions we want to answer in this research. So how do we measure banks' commitment to climate-related disclosure? We use this task force of climate-related financial disclosure, the so-called TCFD. Many of you may already know TCFD, right? It's an initiative basically launched by the G20 ministers, and the chairperson of TCFD is Michael Bloomberg. And this organization was basically established in 2016. At the end of 2015, and the memberships of TCFD, the task force was announced in 2016. So many banks becomes member of this task force. And what is the task for this task force? The task is to this TCFD, this organization, is tasked with preparing the climate-related financial disclosure standards. They are the standard maker. They basically provide the standards, disclosure standards that are recommended to the financial sector and the real sector, and many supporters actually support their standards. So we use this as a exogenous shock to borrower firms. So our argument is that if some banks are selected to be the initial members to set the standards, right? Those banks obviously were gonna have a higher commitment to climate-related disclosure because they are standard setter, right? So their reputation is on stake. If they become members of TCFD, they were gonna be have a much higher level of commitment to transparent climate-related disclosure than other banks who merely just support the initiative, right? So we use the banks becoming members of TCFD, the task force, as a exogenous shock to the borrower firms, right? Because any single borrower is unlikely to influence a bank to join or not to join TCFD as a member, because the TCFD memberships are basically selected by FSB, the Financial Stability Board. So the initial 32 members of TCFD are selected by FSB, Financial Stability Board in 2015. So these initial members include various organizations such as banks, large banks, insurance companies, asset managers, etc. So within these 32 members of TCFD, we find there are 10 large banks or financial institutions that actively give out syndicated loans in the syndicated loan market. So these 10 members are like JP Morgan Chase, Barclays, HSBC, UBS AG, and ICBC from China, AXA, and Banco Bradesco, and then BlackRock, Canada Pension Plan Investment Board, and Swiss Re. So these 10 banks and lenders are actively lending in the syndicated loan market. So that allows us to see, is there any impact of these big banks or lenders joining TCFD, becoming member, would have impact on the borrower firm's environmental record or not? Our argument is that if you are the standard setter, you become the member, you are setting the disclosure requirements, then you're gonna have much stronger incentive to uphold those requirements, to basically provide more transparent information. So our question is, would this actually make the lenders of those, make the borrowers of these lenders improve their environmental record? And if yes, through what mechanism? So, let me give you a bit of background of the TCFD. The Task Force of Climate-Related Financial Disclosure is based on the request, it's established based on the request of the G20 finance ministers and the central bank governor, especially the governor of the Bank of England. So the TCFD, this task force was established by FSB, Financial Stability Board, in December 2015. And the TCFD is committed to improve market transparency and disclosure on climate-related information. So initially, the supporters of the TCFD are mainly in the financial sector, but now it's actually spanned to almost all the real sectors as well. So since 2017, TCFD has been releasing climate-related financial disclosure recommendations around 4 areas. Like these 4 areas are governance, strategy, risk management, and metrics and targets, right? Especially the emission metrics and targets, etc., are very important information. So TCFD is setting the standard for climate-related financial disclosure, and now these standards are widely adopted by many firms and banks. At least they claim that they are supporters of TCFD's recommended standards. So as I just mentioned, the first question we study is, does the lender's commitment to high level of transparency in climate-related disclosure as proxy by being a member of the task force in setting the standards, would that actually help improve the environmental performance of the borrower firms? So as I mentioned, we look at basically 3 environmental performance measures. The first one is EPA enforcement. Second one is toxic chemical release of those firms. And the third one is Kld Environmental Score. Across all the 3 measures, we find significant improvement of the borrower firm's environmental record. Just give you an idea. Basically, we find that after the lender become member of TCFD, those borrower firms, their likelihood of being enforced by EPA reduced by about 1/3. And the aggregate toxic chemical release of those borrowers also decreased by about 30% or 1/3. And also there was significant improvement of Kld Environmental Score of those borrower firms as well. And then after we document a significant improvement of the environmental record of the borrower firms, our second question is, what is the mechanism that leads to such improvement? There are 2 mechanisms that we look at. The first is monitoring. Maybe those lenders actually actively monitor their borrowers after they becoming members of the TCFD. Those banks actively monitor their borrowers, which lead to improvement in environmental record. This is one possibility. Another possibility is you're just closing the tap. You just reduce the credit supply to the brown firms polluters, right? And shift the financing to the non-polluters, which then help basically help increase the financing costs for those fossil fuel industries, and then basically make them to become greener, to improve their environmental records. So what we find is the result. We do not find any evidence on monitoring, but we find very clear evidence on credit rationing, reducing credit supply to brown firms and increasing the cost of financing for those brown firms, which actually, our third finding is that these actions from the bank actually make the brown firms experience more financial constraints. They are more likely to experience financial constraints. And this actually force these polluters to become greener and improving their environmental record. So this is basically a very quick summary of the results of the paper. And what is the contribution of the paper? I think this paper is the first paper that shows if the lenders increase their commitment on climate-related financial disclosure, this would then be able to help really improve the borrower firm's environmental record. So these arguments that I throw out at the very beginning of this presentation, saying that many people believe that the financial sector can help save the planet. This is indeed the case. If the financial sector can do something, actually it will really be able to help improve the real sector's environmental performance. So this contribute to the banking literature, and especially there was a recent review financial study paper by Houston and Shan show evidence that good ESG banks tend to match with good ESG borrowers. And then the banks have some influence on the borrower's ESG performance through loan renewal channel. Our paper complement with their paper. We find that banks can do much more if the banks can provide transparent disclosure or commit to a higher level of transparency in disclosure, then actually will help improve the borrower firm's environmental record. And then we also contribute to the literature on CSR reporting, corporate social responsibility reporting. There's there are very scant evidence on the real effect of CSR disclosure. And we are the first paper to show the impact of lenders' climate-related disclosure commitment can have substantial influence on the borrower's sustainable performance or environmental performance. So, now let me go to the environmental setting. Some of you may not from a finance background or a financial research background. So, in terms of the setting, there are some technical words. I would try to make it as easy to understand as possible. So the idea is basically we use the lender's commitment to a higher level of climate-related disclosure as a shock. And this shock is exogenous to the borrower firms, right? Exogenous means that the borrower firms is unlikely to be able to influence the lender to join TCFD or not to join TCFD as member. Right, because the membership is selected by FSB. As a single borrower firm is so small, it's unlikely to basically will be able to influence its lender to join or not to join TCFD membership. So the lender's joining of TCFD membership is completely exogenous to the borrower firm, right? So from the borrower firm's point of view, suddenly my lender's disclosure level or commitment to disclosure significantly increased, right? So then with this exogenous change in the level of commitment, then we look at whether the borrowers are going to be affected by this exogenous change or not. How is the environmental performance get affected? And then we use this very standard difference in difference regression framework to conduct our analysis. So so basically, what is the difference? Difference is we need to have a set of treatment firms. So the treatment event is the lenders joining TCFD membership, right? So this is the treatment. So in total, basically, there are 32 members, right? 31 of them was announced in 2016. 31 of them. So we identified year 2016 as the treatment year. In this year, TCFD was established, and then the members are announced, right? So and in 2017 already, this task force already released a set of disclosure standards to the financial sector. So we use 2016 as the treatment year. So we have the treatment event, and then we need to have the treatment firms and the control firms. We need to have a set of firms that are treated by the event, and a set of firms that are not treated. So the set of firms, we call it treatment firms. Those are basically borrower firms that have been ever granted any loan arranged by the TCFD member banks. Remember that I tell you that there are 10 TCFD member banks, right? If your firm have ever been granted any loan prior to the TCFD establishment by one of these 10 banks, by any one of these 10 banks, then the firm is a treated firm. And we identify other firms as control firms if those firms are ever borrow from the US syndicated loan market, but they are not granted any loan in the 4 years in the years before the establishment of the TCFD, then we say they are control firms. So we have two sets of firms: treated firms that have ever borrowed a loan that is arranged by a TCFD member bank before the establishment of TCFD. Those are treated firms, and control firms have never been granted any loan arranged by TCFD member banks. So they are control firms. And then we look at how this event actually affect the treated group and the control group differently, using this difference in difference regression framework. And the dependent variable we use is basically to look at environmental performance. We have three measures. One is the EPA enforcement action. The other is the toxic chemical release. And then we have the Kld Environmental Score. So now let's look at the data. So for the EPA enforcement actions, we obtain the EPA enforcement actions from the EPA's Integrated Compliance Information System, ICIS, which actually document all the federal level, US federal level enforcement, environmental enforcement of real sector firms. So, and then we also augment this data with the other state level enforcement cases from various environmental regulations, such as the Clean Air Act, Clean Water Act, etc. So we have the federal level enforcement, and we combine it with data on state level enforcement. So we have local enforcement and federal enforcement combined together to construct a comprehensive enforcement data set. And then we also obtain from the Toxic Release Inventory Program database provided by EPA, the TRI database of EPA. We obtain the toxic chemical release of all the US plants, right, that are tracked by the TRI database. And then we basically match the plants with their parent companies, right? So the parent companies are public firms, right? So that we will be able to find data with. So we carefully match the plants to the parent company, so that we can further match to the 𝐤𝐥𝐻 database, the syndicated loan database. And then we have we also obtain the Kld environmental scores from the MSCI Kld database. Kld was sold to MSCI in early, I think it's 2010 or 2013. So Kld was absorbed to MSCI, and Kld stopped the update of their data series in 2018. So we'll be able to get the Kld data up to 2018. And then the syndicated loan data is from 𝐤𝐥𝐻 database, the Thomson Reuters loan pricing LPC loan pricing corporation 𝐤𝐥𝐻 database, and then we get other data like financial data from CompuStat database. So just give you a bit of our summary stats of the sample. So yeah, so we to construct the sample, we keep any firm in the DSCAN database that borrow at least one syndicated loan in the 4 years, 2012, 2015, right? We remember that TCFD is effectively established in 2016, right? We look at this 4 years before the TCFD establishment. Any firm that have ever borrowed any syndicated loan in the US market enter our sample. And then we classify treaty firms are those that borrow at least one loan that is arranged by a TCFD member bank. And the control firms are those that never have a loan that is borrowed from the TCFD member bank. Those are control firms. And then we also exclude financial firms. We'll mainly focus on the real sector because we are interested in seeing whether the commitment to more transparent climate-related disclosure by the lenders will affect the real sector's environmental performance. So we exclude all financial firms, and we also exclude utility firms that are heavily regulated by the government. So we look at other real sector firms. So this is our firm level sample has almost 15,000 firm year observations. And then because the KLD only covers the Russell 3000 firms, right? So KLD has a narrow coverage. So for the availability of KLD score, we only have about 7,000 firm year observation. We have KLD score, and Toxic released the TRI database cover even fewer firms because to be able to enter into the TRI database, the firm must have a plant that is big enough and emit a sufficient amount of toxic chemicals. Then it will be tracked by TRI. So for the firm years that are covered by TRI database, we have only 3,300 firm year observations. So from this summary stat, what you can see is that about 9% of the firm years are enforced by EPA, right? We only look at formal and informal enforcement by EPA. We do not look at violation. So for a firm to be counted as being enforced by EPA, a simple violation is not enough, right? Because simple violation could be just a phone call from EPA saying that your firm is actually currently violated EPA standard and you need to improve, right? Those are just warning. And we count EPA enforcement using basically you need to have a formal enforcement either through a legal case or an informal enforcement through an administrative process. So in total, we have about 9%.
Sir, ma'am ने mail पे भेजा है.
So we have about 9% of firm years that are enforced by EPA, and then our sample firms on average every year release about 750 tons of toxic chemicals to the outside world. And then this is some borrower characteristics. We have total asset, capture the size of the firm. Those firms are pretty large on average. Profitability, they are profitable. They have the Tobin Q average valuation about 1.8 times. And then we have the leverage, 𝐬𝐵 score firm age, about 25 years. And we also classify our sample firms into polluter or non-polluter. So how do we classify a firm as a polluter firm? If the firm, before the establishment of TCFD in 2016, if before the establishment of TCFD, if the firm has ever been enforced by EPA for environmental issues, has ever been enforced by EPA, then we say the firm is a polluter. If the firm has never been enforced by EPA before the establishment of the TCFD, we say it's a non-polluter. On average, about 30% of our firms are polluter firms in the sample. Firm years, about 30% are polluters. Now, if you understand difference, right? It's just running a regression. We regress our environmental measures on this variable called TCFD client. Is just like the treatment dummy, like a treatment indicator, indicate whether the firm is a TCFD member bank's client firm or not, right? So has ever borrowed from a TCFD member bank before the establishment of TCFD or not, right? So if yes, then it's 1. otherwise it's 0. And then post TCFD, the years after the establishment of TCFD, this post dummy equal to 1, otherwise it's 0. So we exclude the TCFD establishment year from the sample. In our standard DID analysis, we exclude the treatment year 2016. So our sample include basically 8 years. The 2012 to 2015 is the pre-treatment years, and then 2017 to 2020 are post-treatment years. So, and we include the firm fixed effect, which absorb the TCFD class dummy, and the year fixed effect, which absorb the post TCFD dummy. So this interaction term basically is 3 times post, which capture the difference in difference effect. Basically capture the improvement of the treatment firms from before to after the TCFD establishment relative to the improvement of the control firms in environmental record from before to after the TCFD establishment, right? So this is the difference in difference is the term. Basically look at the incremental improvement of the treating firms relative to the control firms in terms of environmental record, and the changes from before to after the TCFD enforcement, TCFD establishment. So as we can see, basically we find, and also we in some regressions we include the firm characteristics as control. Like we already have these firm borrower characteristics, right? In some regressions we have this as control. In some regressions we do not, because we worry that this treatment may actually influence some of those firm characteristics, which would then bring in back control issues. So for robustness concern, we have different specifications. Across all specifications, we find a significant reduction in the likelihood and in the amount of EPA enforcements that is imposed on the treating firms relative to the control firms. So as we can see, basically EPA enforcement likelihood decreased by about 3% after the establishment of TCFD for the treating firms relative to the control firms. This is really large amount. Why? Because as you see, the average enforcement likelihood is 9%. So a reduction of 3% in EPA enforcement likelihood translate into about 1/3 of EPA enforcement reduction. So those firms are actually suggested those firms are improving their environmental performance, right? So they are less likely to be subject to EPA enforcement afterwards, after the TCFD establishment. And this result is consistent no matter if you use a dummy, EPA enforcement dummy as the dependent variable, or if we use the log of the number of EPA enforcement, the results are all consistent. And then if you know different analysis, right, it's very important to establish the parallel trend, because if this incremental change of the treating firms actually occur before the treatment event, that would suggest that this incremental change is not driven by the treatment event, but driven by something else, right? So it's really important to establish the parallel trend condition. So to do to check whether the effect only show up after the treatment, but not before the treatment, we use the dynamic DID regression approach, right? So basically, we use the very first year in the sample as the reference year, and then we construct year dummy to interact with the treated dummy, TCFD client dummy. So as we can see, basically, before the treatment, there is no incremental difference between the treated and the control group at all in terms of EPA enforcement. And the significant difference only occur from year 0 onwards. And actually, it show up starting from year 0, the TCFD enforcement year. When we do the dynamic DID analysis, we will include the treatment year back to the sample. So we find that the effect occur starting from the treatment year 2016, and then it gets bigger and bigger. The impact becomes more and more significant in the following years. So there is no reversal. This is very important. The effect is permanent. There is no reversal. And the effect is there no matter if we include the firm characteristics or not, right? So if we plot the coefficients of this dynamic DID regression in this graph, you see that before the treatment, there was really flat. There was no change in the treatment group's environmental performance relative to the control group, right? But really this incremental change only occur after the treatment. once the treaty firms are treated, you find that their likelihood of getting enforced by EPA significantly decrease, and it's always going down. So suggests that their environmental records is improving. And then we also look at other measures of environmental record. The first is toxic release, toxic chemical release. We use the log of toxic chemical release. We find that the toxic chemical release decreased by about 30%. This is large, right? And it's very consistent with the EPA enforcement. EPA enforcement, we find there are about 1/3 reduction. For toxic chemical release, we find it decreased by about 30%. Whether you control for the firm characteristics or not, the results are very consistent. And environmental record improved by 0.01. For KLD environmental record, we look at basically the strength minus the concerns, right? So it's the next strength. So the average KLD score is 0.09, and the improvement of 0.01 is quite significant, right? It's basically 1/9 of improvement in KLD next strength. So suggests that the environmental record of those treated firms indeed improved significantly. And a nice thing is that we also find, even if you look at the toxic release or the KLD score, we also find they satisfy the parallel trend condition very well. Before the treatment, there was no change, no incremental change of KLD score and toxic chemical release for treated group relative to control group. There's no significant change, but the effect only show up from year 0 or year 2016 onwards and gets bigger and bigger, right? So there is no reversal. For the KLD score, because I told you that KLD was acquired by MSCI, and then it stopped renew its score from 2018. So we stopped in 2018, right? But you see clear trend of improvement in environmental score for KLD as well. So, and then we expect that if there is significant improvement in environmental record, right? Our conjecture is that this improvement is more likely to happen for the polluters than the non-polluters. Remember that in our sample, we have about 30% of polluters, right? The other 70% of firms are non-polluters. And we define polluter as if a firm, before the establishment of TCFD in 2016, if the firm has ever been enforced by EPA on environmental matters, then it's polluter. If it's never been enforced by EPA, then it's a non-polluter. What we find is that this improvement in environmental record is mainly focused on the polluters, but not on the non-polluters. No matter if we look at EPA enforcement or if we look at toxic release and KLD environmental score, we find the effect is only focused, concentrated on the polluters. What does that tell you? It tells you that after the lenders commit to a higher level of climate-related disclosure, then basically it is the polluting borrowers that are affected the most. They actually improve significantly their environmental records. But the non-polluter, they are not really affected, right? Because they do not really polluting the environment. They are not really affected. This is reasonable results, consistent with our conjecture. And then after we investigated the first question, whether the real sector environmental records is improved after the lender or the financial sector increase their commitment on climate-related disclosure, our answer is yes. Then the next question we ask is, through what mechanism that the lenders will be able to improve the real sector's environmental performance, right? For this, to answer this question, this mechanism question, we turn to a loan-level sample. So we keep all loans granted to US public firms between 2012 to 2020, exclude loans granted to financial firms and utility firms. Our sample basically consists of all loans actually granted to public listed firms in the US from 2012 to 2020 during our sample period. After imposed data availability, we require non-missing variables on all of these variables, on borrower characteristics and on loan characteristics. In total, we get about 8,000 loans, 7,800 loans. So we have the borrower characteristics of those loans, right? among all of these loans, right, about 40% is granted to polluters, and about 60% granted to the non-polluters, right? So, and then we also have the loans characteristics. For example, the loan spread, right? Like the average interest rate spread is about 232 basis points. And also, we also have loan size. Average size of the loan is about 700 million US dollars, right? Maturity is about average maturity about 55 months, etc. And collateral, on average, about 50% of the loans have collateral, things like that. And number of lenders, on average, a syndicated loan has about 8.6 lenders, etc. So now to understand the mechanism, right? We look at two channels or two mechanisms. The first channel is the credit rationing channel. So we conjecture that one possibility that the lenders will be able to influence the borrowers is through tightening the credit supply to those polluting borrowers, right? How to tighten the credit supply? The first thing is maybe they're going to increase the interest rate spread lending to the polluters, the polluter borrowers. So we look at, we use this long sample, we look at the interest rate spread as the dependent variable, right? We look at the loans interest rate basically. So this is a loan level difference in difference regression, right? So a TCFD arranged is a dummy which equal to 1 if the loan is arranged by a TCFD member bank and equal to 0 otherwise, right? And post TCFD is the dummy equal to 1 if the loan is arranged or is granted after the establishment of TCFD in 2016, and it's 0 otherwise. And we include the firm, the borrower firm characteristic control, and then we also include the firm and lender fixed effects in some specification. In some other specifications, we include the firm times lender fixed effect. Include this firm times lender fixed effect actually effectively control for any endogenous matching between the borrower firm and the lender, right? So in some other specification, we even control for the firm times lender fixed effect. And we control for also year fixed effect, long type fixed effect, long purpose fixed effect, etc. And what do we find? We find that actually for the polluter loans, for the loans issued to the polluters, we find a significant increase in loan spread, in interest rate spread by about 5 to 6%. This is the log spread, right? So it's about 5 to 6% increase in loan spread, translate into about 14 basis point increase. If we look at the average spread is 232, right? So with this increase translated to about 14% in basis point increase in interest rate lending to the borrower firms. So their cost of financing increased, but we do not find any effect on the non-polluter firms. For the non-polluter firms, the loan spread do not change, consistent with credit rationing. And we also look at whether there is any evidence of monitoring. The lenders actually increase their monitoring on the borrower firms' activities, which then lead to a reduction in pollution behavior or not. So to look at the monitoring, we look at a few things. First of all, the loan maturity, right? Because the literature suggests that if you lend a loan to a borrower, if the loan maturity is shorter, then it's more convenient for you to monitor, right? Because every time when you need to renew the loan, when the loan expires and you need to reissue the new loan, you have more chance to monitor, right? So to increase monitoring, you're gonna issue shorter maturity loans to the borrower. We do not find any effect on maturity of the loans, and we also do not find any effect on size of the loans. And literature also suggests that lenders can use collateral and use covenant to monitor the borrowers. We do not find any effect on covenant and collateral usage. And also there is no effect on number of lenders as well. All of this suggests that monitoring is likely not a channel. So we dig deeper into the credit rationing channel to see whether indeed credit rationing is the channel that basically the lender tighten its credit supply to the polluters, which then cause those polluters to experience higher cost of financing more financial constraint, which then lead them to improve their environmental record. We want to see whether this is the channel. We're going to dig deeper. So how do we do? We construct a detailed sample, which is a firm borrower bank pair year level, a very comprehensive sample. Basically, this panel data set is at the firm bank pair level. We have each firm bank pair. We have multiple years of observation. We want to see within each firm bank pair if this firm bank pair is the bank is a TCFD member bank, then after the TCFD establishment, whether there's less likely to issue a loan to a polluting borrowers or not. And if issue a loan, the loan amount, the dollar amount also would decrease or not. So remember that this is because this is a firm bank pair year level sample, it allows us to control very detailed fixed effect. We can control for the firm lender pair fixed effect to control for any endogenous matching between the firm and the lender. And then we can also control for the firm times year fixed effect, which will control for any dynamic loan demand from the firm, right? So we have very detailed fixed effects. Firm bank pair fixed effect to control for endogenous matching, and then firm times year fixed effect to control for any dynamic demand, loan demand from the firm. And this TCFD firm bank pair dummy equal to 1 if the bank is the TCFD member bank, and equal to 0 otherwise. And the post TCFD equal to 1 if it's if the dummy if the year is after the TCFD establishment after 2016 and is equal to 0 otherwise. So we look at, for this sample, we look at two subsample. One is the polluter subsample, the other is the non-polluter subsample. And our dependent variable is whether in a certain year a loan is issued to the borrower or not, right? If there is a loan issued in a certain year to the borrower, a new loan issued, then it's 1, otherwise it's 0. This is a dummy variable as a dependent variable. And we also look at not only a 0, 1 dummy, we also look at the number of loans that is issued. And we also look at the dollar amount of loans that is issued to the borrower. Across all the 3 variables, we find a significant reduction in the amount of loans provided to polluters, to the treated polluters after TCFD, but only for the polluters. For the non-polluters, we do not find any effect. So what does that tell you? It tells you that if your firm is a polluter and if your bank happened to be a TCFD member bank, then after the establishment of TCFD, within a firm bank pair, there is going to be less capital flow from the bank to this polluter firm. If your bank is a member bank, there's going to be less capital flow lending from the bank to the polluter firm. And the reduction is significant. The reduction is 15% less likely that the polluter will going to be issued a loan after the TCFD from the member bank, a TCFD member bank. And the number of loans also significantly decreased by about 20%. We use the log amount, right? So it's about 20% reduction. And the amount of loan amount decreased by about 4%. This cannot be interpreted as 400%. Why? Because this number is really large. So it's not 400% anymore. It's exponential of -4. So the reduction is exponential of -4 minus 1. So as you can see, there is a large amount of reduction in the loans flow from the member bank to the borrower, polluting borrower after the TCFD. But the effect is not there for the non-polluting borrower, and especially because we control for the pair fixed effect and the borrower firm year fixed effect, right? So any concern on dynamic loan demand or endogenous matching will be excluded. So the effect clearly shows it's a treatment effect from higher commitment to climate-related disclosure of the lenders. The treatment effect is very significant on the borrowers. It's a tightening of credit supply from the member bank to the borrower firm.
And then hi, Bo Hui. Can I have a minor question regarding to the pairings? Just to confirm, like whether that pair like one firms can be paired with multiple bank and bank can pair with multiple firm, right?
Yeah, exactly. In this case, a borrower firm can borrow from multiple banks, right? So it's going to be multiple pair. So each firm bank pair we have multiple years as well. So this is the reason that we can control for the firm times year fixed effect and the pair fixed effect. So this is a very detailed control. So we basically look at each firm bank pair, whether after TCFD, whether there is a reduction in capital flowing from the bank to the firm or not. So so this is actually, this approach is now quite widely applied in the banking literature that allow us to use very fine fixed effects as controls. Yeah, thanks, Han. And we also look at the aggregate measure. Then we look at the bank level. We conduct a bank level regression to see whether banks are less likely to allocate in their portfolio, allocate money or funding to the polluters or not, right? So how do we do? This regression is conducted at the bank level. For each bank, we look at its lending book. We look at basically, we look at the total amount of loan the bank give to borrowers, syndicated loan give to the borrowers. And then we look at among this total amount, how much is given to the polluters. And the polluters amount divided by the total amount is a percentage, right? And then we calculate the average percentage of the loans given to the polluters in the bank's lending book before the TCFD and after the TCFD. And we calculate the change. The change is from after minus the before. So for each bank, we have one observation. Look at the change in its lending book, the percentage change that is given to the polluters. And then we run a cross-sectional regression. In total, we have 462 banks in our sample. And then if the bank is a TCFD member bank, then the dummy equal to 1, otherwise it's 0. So this is just a simple regression without any control. We just want to see whether in the bank's lending portfolio, whether it reduced the lending to the polluters or not. And what do we find? We find indeed, after basically, if your bank is a TCFD member bank, and after TCFD establishment, there is about 5% reduction in your total lending portfolio given to the polluters. So this is a very sizable amount. Why? Because we find that the average percentage of loans that given to the polluters is only about 13% in the book in a bank's lending book. So a 5% reduction, 5% divided by 13% is actually a 40% reduction in capital flow from the member banks to the TCFD to the borrower firms, to the polluter borrower firms. So basically, that suggests that there is a significant tightening of credit supply to the polluters. The reduction is 40%. So this is no doubt why those polluters are going to be significantly affected, and they need to become greener. Otherwise, they can't get financing from those banks anymore. So, and then if we find such a significant tightening of lending to the polluters, right, polluter borrowers, then we would expect those polluters, perhaps they were more likely to experience financial constraint. So what do we do? This is a firm year level regression. We use 6 measures of financial constraint to come up with a summarizing measure of a firm, whether the firm is experiencing financial constraint or not. We have these 6 measures, which is the Kld Environmental Index, the HP Hadlock Pierce Index, the 𝐷𝒐 and 𝐸 Index, and then we have firm size, we have payout ratio, we have credit rating. So for each measure, right, we classify the firm according to either median or for this yes/no measure. We classify the firm year as whether it's constrained or not constrained. And then we summarize if among the 6 measures, the majority of them indicated the firm is in financial constraint, then our financial constraint proxy equal to 1, otherwise equal to 0. And then we use this dependent variable, the financial constraint proxy, a dummy variable regressing on TCFD client. So TCFD client, if the firm is a TCFD client firm or a treatment firm, then it's 1, otherwise it's 0. Post TCFD is equal to 1 if the year is after 2016. And then we control for the firm characteristics. We also control for firm fixed effect and year fixed effect. And then after we run this regression, what do we find? We find that for polluter firms, we find a significantly positive coefficient on the treat times post. What does that mean? It means that they are more likely to be subject to financial constraint. They're actually 8 to 10 percentage point more likely to be subject to financial constraint after the TCFD. But we do not find such effect for the non-polluter firms. It suggests that after tightening of credit supply by the lenders, those polluters are actually about 10% more likely to subject to financial constraint. And then we also look at, are there any real effect on the polluter firms or not? We look at whether their profitability and sales growth and top-end skill is affected or not. What we find, we do not find any effect on profitability in terms of ROA and sales growth, but we find significant improvement in firm valuation. What does that mean? There is a strand of literature suggests that the capital market penalizes those firms that are polluting the environment. So if you can improve your environmental record, your top-end skill, your valuation will going to increase. And what we find is that for polluters, given that they improve their environmental record, we find actually the capital market favorably value such firms afterwards. So although they do not have significant improvement in sales growth and profitability, but we do not find any effect on the non-polluter firms. Suggests that basically the impact is mainly on the polluters. So to conclude, so in this paper, we provide the first evidence that lenders' commitment to more transparent climate-related disclosures can be an important driver of the real sector's environmental performance. So it's an important driver of sustainable financing. The impact is through the credit supply channel, right? So through credit rationing and higher loan costs would then force the polluting borrowers to basically improve their environmental record. And from a policy perspective, we believe that the paper is relevant to the recent change in climate-related disclosure requirement in the financial sector, right? For example, in last year, EU adopted the Sustainable Finance Disclosure Regulation, basically require financial sectors to start to provide climate-related disclosure, sustainable disclosure. So we offer the first empirical evidence on the real effect of the lender's climate-related disclosure commitment, right? We find that indeed those borrowers' environmental performance significantly improves through the credit rationing channel. And we suggest that indeed the banking sector, the financial sector, can do something to save the planet as conjectured. And that's pretty much what I want to talk about. Thank you very much, everyone.
Thank you so much for your presentation, and I trust that audience did enjoy your presentation, and because it's quite longer than usual because it's very insightful presentations. So now I think we're gonna have maybe 10 or 15 minutes for the Q&As. If any question for the audience.
Hi, Bohus, and hi. Thanks a lot, Bohus, for great presentation and great papers. I like it very much. I think it's really interesting, really topical, and really thorough analysis that I can see. If you look at the charts, there's some of the information, some of the facts actually Ivan's I think in the University of Otago has given, and it's quite useful. That's like UK is not the first to 6 disclosures of climate risk. France has related law implemented in 2015, and New Zealand going to be implemented soon as well in 2023. So I think that is the interesting fact.
Oh, okay. Thank you for correcting me. So
that's that in the chat that I just see it actually. Yeah. And the other thing is just like my curiosity regarding to like how long the borrower can have some transformation regarding to their like their positive impact on like becoming less polluters after getting the fund from the bank. I mean, it's like the timeline maybe will depend on different sector, right? Some industry or some sector they can quickly adapt to that, and becomes less polluted. But some sectors might take a longer time to adapt to that requirement, right? So yeah, just my curiosity. So I'm not sure, like
totally
how long or what is the difference among the industry that they can adapt to that. Yeah.
Yeah, we haven't looked at the industry level difference, but it would be very interesting to, for example, single out some industries, right, to see whether there was any heterogeneous treatment effect or not. Yeah, thank you.
Yeah.
We haven't do that, but yeah, it's a good suggestion. One thing I want to mention is that we are in the analysis in one set of tests. Oh, I didn't show, but we control for the industry times year fixed effect as well.
Oh yes. Yeah.
The result is still valid. Yeah. So yeah, but it will be interesting to look at, for example, among the polluters, different type of industries, whether the treatment effect are different or not. Yeah.
Yeah. Thanks, Paul.
Thank you. Yeah. Yeah, I saw some questions in the chat box. There's actually quite a lot of questions. I see whether I can answer some of them. Yeah. UK is not the first to seek disclosure. Yeah, as mentioned, of climate risk, has released a law implementing in 2015. Thank you very much. Yeah, I have to take into this. We thought UK. When I say UK is the first, UK disclosure is the most comprehensive. It's not only related to financial sector, but actually real sector. So we're saying that UK is the first country that require all firms, financial or non-financial, to disclose this information. So yeah, I would take note on the like other. I will copy this now. So I will copy this now, and because it's let me see. Let me see whether I yeah, it's good to save this. Yeah. So let me see if there's any other questions. So there's a question
from Justin. Yeah.
Oh yeah, from Justin as well. Yeah, before Justin, I think there was a question privately to me. There was a question on what factors the lender's bank would determine that the borrower firms are polluters. Okay, yeah, for this question, basically I explained that we define polluter if the firm has been enforced or penalized by EPA before the TCFD. We call it a polluter. But I understand that you may have concern that can we use alternative definition of polluters? For example, if your firm actually is a fossil fuel firm, right, producer, things like that, right? So, for example, oil producer, would this be a more suitable polluter definition? We were going to look at alternative polluter definition as well. Yeah, thank you. And then Justin has a question. TCFD disclosure is voluntary or mandatory? TCFD disclosure is basically at the moment is voluntary. It's the TCFD, the task force, recommend a set of disclosure requirement for all firms to voluntarily adopt. So many firms and banks actually voluntarily support the TCFD disclosure requirements. So yeah, it's voluntary, but there is actually more and more governments consider to make the TCFD disclosure requirement mandatory. Right, so we see that the EU is moving to last year, and then UK is gonna adopt the requirement in 2025. Actually, US SEC is gonna adopt some requirements in 2022. So more and more governments are recognizing the importance and start to make things mandatory. So the TCF, quite hard to improve environmental performance in such a short periods of time. Yeah, so I think one important thing for the improvement to be made, right? So one important thing is you just close down the tap, basically reduce the credit supply to these firms, right? If they have no money, then basically they have to do something. They have to reduce, for example, shift some of the investment project from the polluting ones to the non-polluting ones, right? Otherwise, they can't get any money anymore. So this actually could be quite effective. We find that the effects actually show up from year one onwards, and it's getting bigger and bigger. So the TCFD mandates bank to disclose environmental performance of lenders or their borrowers. So the TCFD disclose basically require the banks to disclose the banks several things. One is when TCFD is established, the recommendation is previously the target is the financial sector, but it expand to the real sector as well. And the disclosure is basically structured in a few areas. One is governance. How do you basically through corporate governance what is the information of the firm's corporate governance that is related to ESG, especially environmental performance, and the firm's environmental strategy, risk management strategy on environmental issues, and then the environmental performance metrics and targets. So so the disclosure is basically to both lenders and borrowers, I would have to say, right? So because it's originally target the financial sector, but it's actually expanding to also to the real sector on 4 different areas of environmental related issues, right? That I just mentioned. If on lenders only, then motivations for loan cost supply isn't clear. So it's basically on both lenders and borrowers, right? So so the idea that we have is that if the lender are the standard setter, if your bank is actually one of the task force member, then basically since you are setting the standards, right, you have strong incentive to uphold your standard. Otherwise, your reputation will be significantly damaged. And we actually we are currently basically because the paper is very early draft, we are revising it. So one thing we find is that those member banks actually they are the first among the first to disclose the finance emission. So for the banking sector, one important number is how much carbon emission that you finance every year. So those banks are among the first to disclose the finance emissions. So this also showcase their commitment to the disclosure, transparency, and they are basically they release the climate reports. Those member banks release the climate report pretty faster than the supporter banks. And possible alternative explanation is TCFD banks switch loans from polluter to non-polluter. Yeah, that's a very good suggestion, Justin. We actually, I do not provide the result. In one of the robustness tests, we single out and exclude all the switchers that previously they borrow from the member bank, and then they switch to borrow from a non-member bank. We remove all of those switchers. Our result is remain unchanged or even stronger. So it's basically it's not driven by the switchers. So I think there is another question. We know the northern world is more contributor to the carbon emission, while the southern countries are victim. The paper shows that TCFD is contributed to provide a financial regulation such emission. However, in terms of adequacy for achieving the SDG 13, is it sufficient to reach the global target? What are the key limitations to reach such target?
So I think I think this question is quite broad. It's quite broad.
Yeah.
It's more into the macroeconomics some taste. And if you may I ask one question?
Yes.
May I add one question? Thank you so much again for your
Yeah, thank you.
yeah, for your answer to our audience question. May you remind me a bit and audience a bit the way you set the treatment, because I would love to hear in a bit more detail, maybe because setting treatment is quite critical from the early stage. So that's why it would be great if you can remind us a bit the way you you set the treatment.
Yeah. So so for a firm to be defined as strategic firms, right? So basically, the firm should actually borrow at least one loan that is arranged by the TCFD member bank. That is a strategic firm, and if the before the TCFD establishment. So let me And for the firm to be a control firm, it must be a borrower firm in the deal scan database, but have never borrowed any single loan from the TCFD member bank before the TCFD establishment. So that's the control firms. So that's how we define treaty and control. Is that clear?
Yeah, thanks. Which means that you control for, as you saw in the slide before, that you control for only 6 years before the TCFD time, right? 2016, right? From 2012 until 2015.
Yeah, so the 2012, 2015 is our pre-treatment period.
Okay, okay.
Yeah, and in the standard DID analysis, we exclude the treatment year.
Yeah,
and
yeah, I see.
And in the dynamic DID, we then include the treatment year back to the sample.
And you exclude the T0, right? You include T0 in the sample.
We include T0 in the dynamic analysis, but for the standard DID setup, we do not include T0. That's an idea. Yeah. So we have two groups of firms, right? Treatment are basically those that have ever borrowed at least one loan from the TCFD member bank before the TCFD, then it's treaty firm, and others are control. That never borrow any loan, those are control firms. And then we look at after the treatment, whether the environmental performance changed or not. Yeah.
And yes, thanks. And the TCFD adoption is exogenous to borrower environmental performance, right?
Yeah, because TCFD membership is actually selected by the FSB, the Financial Stability Board. And a single borrower, right? Think about if you are the borrower of JP Chase. JP Chase is such a huge firm. A single borrower firm is unlikely to really influence the decision of the TCFD member bank on whether becoming a membership bank or not, right? So to the borrower, this shock is entirely exogenous. Of course, the member bank themselves can say yes or no when FSB approach them, right? So there's a decision that the member bank need to make whether they want to become a member of the task force or not. But from the borrower's point of view, it's entirely exogenous. So this is the reason why we can use this shock as a treatment event and use the DID analysis to look at how's the impact on the environmental performance of the borrowers.
Thank you so much. I asked because the DIDs and particularly these quasi-experimental, common methods in empirical finance. But recently, I normally employ DID in market microstructure, which is they measure the chain, they set up the treatment based on the chains. For instance, on stock liquidity assumption. So that's why I would love to hear more your explanation on that. And thank you so much. Any remaining question on in the chat box? I think I take along now.
This question just now, whether it's sufficient to reach global target. In our paper, we can't answer this question because whether what we can know from the paper is that by tightening the disclosure commitment of the lenders, right, they will be able to make an influence to the real sector's environmental performance. And especially if you look at the toxic chemical release, right, a reduction is 30% is pretty large. And it's also a 1/3 reduction in the likelihood of being enforced by EPA. So this suggests to us that the impact could be pretty large. But whether this is sufficient to make the global target or not, we are not sure.
I see that's question. I also in line with the audience question, but it's quite broad at the end. And as our speaker put into the conclusion that we provide the very first evidence on the real impact of TCFD adoption, which is the one of the crucial sustainability initiative to make that firm more committed, particularly here the lender commitment to sustainability, climate-related orient practice. I think any final question, because we take quite long. I think if you don't have any final questions, we and with the speaker will make conclusion and we will finish our webinar today. Are you all happy with that?
Yeah, thank you so much, everyone. I really appreciate your patience and the comments and suggestions. Really appreciate. Yeah.
Thank you so much, Professor Vu Huy, our speaker today. And I think that's a very timely contribution, particularly on your research as well. And as we mentioned from the earlier in the webinar, Tcft is one of the crucial, and particularly in the European and UK's, and for other advanced economies around the world. That's at the end of the days, we need to have sustainability initiative and right policy to promote, particularly for instance, for your research, that to encourage firm, particularly is polluting sector, to become greener for climate change action. And go back to the audience question, that's SDG 13. Yes, and particularly when we do research in empirical finance, we focus on the firm level and for corporate behavior, where the trade-off between going green or going brown. And thank you so much again. If we don't have any final question, as usual, please allow me to finish our to conclude and to stop our webinar today. And as usual, could you please open the camera, and we have a screenshot picture with the speaker today. Professor Vu Huy, would you love to do it with our audience?
Yeah, sure. Thank you so much. Yeah, really appreciate it.
Please turn on the camera. I'm not sure whether my screen, because we got a very high amount of attendance today, over 60. So that's why I'm not sure whether I can capture all. But Dr. Tâm or Vũ can help me as well. I will also take from my side. But because so many audience, I'm not able myself to capture everyone. So please help to do it. And I will count 1, 2, 3, and we will take a screenshot. Let me check out. Give me 3 seconds. Yes, we ready to go now. I'm counting now. 1, 2, 3. Thank you. I take a few.
Okay. Thank you so much again, and everyone. Yeah.
Also, thank to honestly again, thank to the network director, thank to the organizing committee, thank to people.
Absolutely.
And also thank to the speaker today. Thanks so much because we put a very timely webinar, and along with the discussion, and very timely organization by Finance Banking Network, Economic Policy Network in the AVSE Global. Before our very last month, we have a series of affiliate conference of AVSE, and we have a very timely webinar today with Professor Vu Huy. Thank you so much again, and hope you all enjoy evenings in New Zealand, morning in other country, Asia Pacific, and nice weekend again.
Have a nice weekend.
Yeah, thank you.
See you.
Thanks,
See you, everyone.
Thanks, everyone. Bye.
Thank you, Han. Thank you, everyone. Bye-bye.
Thank you.